Listen, hey guys. All right, once again, Brian Stevens over here with Mortgage Shots. Appreciate you being here. I have my good friend and partner in crime on this, Kristopher Martin. He's a co-CEO over at Oaktree Funding. He was kind enough to put together a really great presentation on HELOCs. HELOCs, I believe to be, if they're not the biggest, they're the largest growing portion of the mortgage market. All those people with the 2s and 3s, not looking at the cash out refinances, but people are, starting to look at pulling money out for a number of different reasons. And as a loan officer, it's a real missed opportunity if you're not going out there and speaking with your past client database about this. And really, it's a HELOC oftentimes can be a gateway for other opportunities for mortgage loan officers and real estate agents. Chris is going to go over all of this today. If anybody has any questions, make sure that you put those down in the question box down below. And by the way, we appreciate questions. It always makes these things much more interesting, and I think much more full spectrum for everybody who's participating. With that said, let's jump right in. Chris, how we doing today, bub?
I'm great. And to your point, there aren't any bad questions. So if you're asking a question, as we tell new mortgage loan officers, if you're thinking it, someone else is thinking it, just ask the question, and we'll get the question. So I'm good. So let's get going.
Let's jump right in. Okay.
Oh, I did something. And there we go. So as Brian mentioned, there's a lot of recent articles that are out right now about HELOCs, about borrowing money, why it's important to be looking at HELOCs right now. And again, I think Brian mentioned this already. We're going to make this presentation available for you to be able to use bits, all of it, some of it, pieces of it with your own clients. Any realtor presentations that you want to do, any financial planning presentations that you want to do, or if you just want to pull stuff up so that you can show people as evidenced by other things in writing, which is a great way for information assisted selling, that you can pull a lot of this stuff up and use it at your discretion. So these are great points as far as if you're talking to a borrower about some of their options. If they're like, I don't want to have a variable rate line of credit, and what about this, what about that? Well, there's a lot of good positive data out there that can back up why they should be looking at a home equity line of credit versus even a fixed rate second that's generally at a higher fixed interest rate for a longer period of time, or obviously refinancing that 2 or 3% interest rate that they might have might be problematic. So Brian, anything else on that?
No, I just, like I said, I love the opportunities on HELOCs right now. Again, it's a Swiss Army knife in the mortgage business. It's got a utility for almost everything that we need to do. My thing right now is kind of taking action on these, but I want to check out what we got going here.
So if anybody's unfamiliar with the home equity line of credit, it's the type of a loan that allows borrowers to use their equity in their property. It's a credit facility. It's a credit card. It's not, we don't actually issue a credit card, but it's essentially a credit card on their house. They get a checkbook. They can write a check. They can request money from the lender directly, from the servicer directly. They're able to use it. When they're done using it, they can pay it back. And then if they need to use it again, it's still there. It's available for them to use. When I did retail lending back in pre-crash time frame, pre-2008, one of the things that we did was, if we found that a customer didn't have a whole lot of cash in the bank, they didn't have a lot of reserves, they weren't 6, 8, 12 months of reserves, we really highly encouraged our borrowers to take a line of credit, because if something happens, they didn't have that backup cash that they need for any type of unexpected expense. So that's one easy route. The other one is that if you're sitting on a 2 and 3% interest rate, I mean, you might want to do an addition to your house, you might want to fix things up, you might want to think about moving, but it's really difficult to think about actually moving into a 7% interest rate. So especially when your payment's that low, it's a big difference in payment factor.
I was talking to a financial planner, Chris, and he goes, you know what? He goes, if I was a loan officer, he goes, and people have equity, he goes, I'd get a HELOC the minute I closed on my house, if at all possible. And he says, for this one simple point, he goes, if you're going to borrow money, do you think you're going to get better terms if that money is secured against something or not secured against something? He goes, just that simple. Right. And so when we look at how we spend our money, if we're spending on credit cards, that is not secured. But when you have a HELOC, it's secured. So your terms on money that you're borrowing, especially like in these high inflationary times when credit cards are sitting at 28%, like HELOCs are a fantastic opportunity for everybody. Yeah, I mean, regardless of how you're going to use them.
Right, absolutely. Obviously, just talking a bit more about this, and you guys are experienced LOs, so if you can put in the questions, go faster or not. If you want to find out more about products, or if you're really interested in figuring out how to do HELOCs and how they all work, then we'll keep going the same pace. So obviously, the HELOC is a revolving line of credit, like we talked about, similar to a credit card. Where a traditional loan is going to have you on a fixed payment. There's no, you're going to have the higher, it's going to be principal and interest. The HELOC is interest only, so that you're only paying the interest that's due. You can obviously always pay more. There's no prepayment penalty for paying the line down, and you're able to. So if you want to make larger payments, or if things are lean, you need to make a smaller payment, you can make that interest only payment. It's not a big problem. Unlike a second lien, if you pay on a second lien, obviously if you can't pay less than whatever the minimum monthly payment is, that's not an option. And obviously, both of them are like Brian mentioned, both of them are secured loans. They are tied to your house, and that also gives them the availability of being tax deductible on the interest. So depending upon your tax situation. All right, now to the good stuff. I know Brian's got a lot of questions about this page right here already. So
yeah,
Oaktree will do up to 90% LTV, full doc, or bank statements. We'll do 12 or 24 months in both. We'll do 90% LTV on second homes, all the way down to a 680 credit score. And we'll go up to 85% loan to value on investment properties. So those are much higher loan to values than we've seen relative to the competition in the marketplace on some of the quote non-QM HELOCs that have come out similar to us or after us. We offer obviously it's a variable rate. It's interest only for 3 or 5 years, depending on if you pick 3 or 5 year draw. And then we could do a fully amortizing period after that, 30, 25, 20, and 15-year amortization, whichever you prefer. It is tied to prime rate. So it's variable rate based on prime plus whatever your margin happens to be. Some of our requirements, just like you guys, we tend to get paid on volume. You guys get paid on volume. So our initial draw we require is 50% of the total line amount and no less than $75,000. We do allow for yield spread. We do allow for borrower paid compensation. HELOCs are not TRID regulated loans, so right. they have a lot different rules to live by. There's no LE, there's no CD, there's none of that stuff. It's the old kind of GFE HUD process on these types of loans. In addition to that, we also allow for no appraisals. So up to $250,000 line amount, you don't actually have to have an appraisal done. We can use an AVM. And AVM plus, that means that if you think about that, if you get your income qualified up front, we do an AVM for the appraisal, we can close these loans in days, not weeks. We don't have to wait the 7 days. They close very quickly. So you want to think about turnaround time for your pipeline. You could sit and spend the middle 2 weeks of the month selling these loans, and then all of a sudden, you're going to be, you can close those loans the same month if you need to. Obviously, owner occupied, second homes, investment, we do limit those to 10 finance properties. One of the big key components on this versus a lot of the second lien programs that are out there is that we'll allow you guys to go up to $5 million combined financing, meaning that you can have a $3 million loan and we can do a $500,000 second behind it. When a lot of our competitors and a lot of the investors that we've seen, they limit that to $3.5 million. So when we don't mind. And if somebody wanted to just do a variable rate line of credit as a first lien, we will allow that as a first lien. It does not have to just be a second lien. We will allow first or second lien, and the loan amount is still maxed out at $500,000.
So, Chris, is a loan officer paid on the draw, the 50% draw?
If they're gonna get paid by rate credit or yield spread or whatever you want to call it, yes, they're paid on the draw amount. They're not paid on the line amount. So it's based on the draw amount. Yes.
So let's say a loan officer wanted to get a borrower paid, and they said, okay, we're looking at, I have a $2,000 flat fee or whatever.
Yeah.
Could that fee could be paid from the draw?
Absolutely. Yep. That's
Okay,
exactly where it would be the draw.
Okay, so you can flat fee this thing, and then there's still a yield spread what is a yield spread? I guess a yield spread's going to probably differ based on terms, right?
Yeah, it's going to differ. We go up to, we'll pay up to 2% YSP, similar to, our other programs, and they can, and they just they increase the margin on the loan to determine what their premium is. These loans aren't locked, by the way. They are, there's no locking because the market, it's always based on whatever prime is. So, but you're putting together what the margin is. So whatever that margin is on top of prime is where you're going to build in your premium.
You know what I would tell people. It's I would tell them your payment today is only going to go down. I would, because nope, the Feds aren't going to raise the prime rate at all anymore, right? If they're going to leave it alone or they're going to lower it, but it doesn't look like they're going to raise it. Honestly, when you're talking with people, say, hey, listen, this is going to be a loan where the circumstance is always and only going to get better. Are there any seasoning requirements?
No.
And do we charge a client? Yeah, we just went over that. So Lena had a question on that. All right.
Oh, there's chat. I'm looking at both. Sorry. I got all right. There was a question I saw too.
Yeah, no, there's two. That one, Jared had a question about if there's any seasoning requirements on. Oh, excuse me, seasoning requirements on investment single-family residence.
No.
No. Okay, that's pretty straightforward. And then Lena had the question: do we charge client on the full line or just on the draw? And I think we established that on the draw. But like Chris said here, Lena,
you can charge the client whatever you want. You could charge, if you're going to do borrower paid and they're doing a $500,000 loan and you wanted to charge them 1%, you could charge them $5,000, but it would just be a flat fee of $5,000. You wouldn't want to do 1%. You would want to key in when you request the loan disclosure, you would want to key in a flat amount because otherwise it would be based on the draw amount. If that makes sense.
Yep. Perfect. Makes perfect sense.
I'm going to double check right now as I have I'm going to go on to the next. I'm going to let you take the next page here.
Okay.
On our first scenarios. Oops. I think I just started this whole thing over again. There
okay.
You go. I'm going to let you go take the first one of the scenarios. I'm double check on the seasoning question because I don't want to give bad information.
All right. All right, so guys, here we go. Imagine a borrower who dreams of funding their child's college education. I think most people feel that way. Now, the borrower has diligently paid down their mortgage over the years and has built up substantial equity in their home. That, by the way, is everybody in your database, that you sold a house to who's owned it for over 3 years. Check, check. However, they're hesitant to dip into their savings or take out a personal loan with higher interest rates to cover tuition costs. Sensing the borrower's hesitation, the loan officer takes the time to understand their financial goals and carefully assesses their situation, recognizing that a HELOC could be an ideal situation for funding their child's education. The loan officer presents the benefits of a HELOC tailored to the borrower's needs. Now, I mean, how many people are in this situation right now? I saw some numbers here. The average cost of education, I mean, if you're looking at $20,000, $30,000, $40,000 a year, this is massive. And the truth is a lot of folks who, have their best goals in mind for their children, their aspirations for them, you'd be surprised how many folks are putting this on like credit cards or pulling out of investment funds that they have, even taking hits on that. When you consider the rate that you're going to get, which is prime plus something, you're going to have a tax deductible, significantly lower interest rate. I mean, even if you're looking at something that was 12 or 13%, with the prime rate in our credit cards right now, you're looking at something that's going to be 27, 28%. So if we're buying our kids' books and we're paying for tuition and we're putting that on cards, or we're using that as a consequence of one of our investments that's being yanked out, a HELOC is going to be a better option for this. Now, I pulled up a slide that I have on my computer right now. And we were looking at inflation, things that have actually gone down in terms of inflation and things that have gone up in inflation. So for example, used cars have gone down, cell phones have gone down, inflationary, those are positive things. But number 3 and 5 on the list, and I thought this was really peculiar, the highest inflation, some of the highest inflationary items that we're finding right now is the cost of education and the cost of supplying the goods for their children for education. So when we're talking about this scenario here, we've got a perfect real life ecosystem in place that would support using a HELOC rather than some other alternatives that I think folks have on the board. So that's my thoughts about this. What about you, Chris?
No, I mean, your children's education is obviously very important. I know so many people that they're still buried in education. I mean, not that I want to encourage this at all in any way, shape, or form, but you know, when you take out college debt, 10 years from now, if you know you decided to go into, I don't know, let's say some line of work that doesn't exist anymore, and you're struggling and you need to file bankruptcy, college debt doesn't go away. I mean, good, bad, or indifferent, mortgage debt does. It's something that can be discharged in a bankruptcy. Now it's tied to your house, so it's part of the secured creditor, but and it's something that you can work with, or get out of completely. When college, your kids, giving your kids college debt, specifically with how the college loan racket works, I think is just it's rough. It's a rough patch to go. And those of you that have college debt, you know what I'm talking about. It's rough.
Well, you get a write-off. That's interesting. I didn't think about that, but you're right. The 2 things that you can't file bankruptcy on are taxes and college debt, college tuition. I didn't realize that. I see what you're saying. Not going down that road, but you have something. At least you have something that's not only going to be tax deductible. You not only have something that's going to come at a decent interest rate, but you also have something that's going to be that potentially could be dischargeable.
Yep. Another way to think about that when we're doing a loan for somebody, we don't want those guys. We want to write loans for people that are defaulting. But like I said, a few years from now, something happens. It is what it is. I do want to get back to you on a couple of things that I said. So I was correct, and I was also wrong at the same time on the seasoning requirements.
Okay.
6 month seasoning requirement is required for investment properties.
Okay.
However, you can use it to purchase. So,
okay.
And then the other option, and then we do not have a seasoning requirement for primary residences or second homes. But it's going to be fairly typical to agencies. So 0 to 6 months, you must use the lower of the purchase price or the appraised value, and then over 6 months, you can use the appraised value or the new AVM value. We had a couple more questions here too.
Yeah, we got John over here. He says, debt to income. If paying off current credit card debt, does that remove the debt from the DTI?
John, I'm not going to lie to you. I am not an underwriter. And the last time that I wrote a loan personally myself, the answer is yes. I don't see why it would be any other way, because this is a non-QM loan. It's not an agency loan. But I will definitely check on that question and get back to you. If you reply privately with your email address, I will get back to you.
You know, I'm going to kind of just double down on that, because you're going to have escrow on this. And I mean, if you had the bills are paid directly through escrow, isn't that, I mean. Yeah.
I want to be certain when I answer the question. It's not on the guideline sheet that I'm looking at. We may require a closure letter, and we may not. I'm not 100% sure on this particular product. That's a great question.
That's a strong maybe, probably.
You stopped me on it. Yep. Go ahead.
Okay, we got one more here. We got Julio Garcia. When using bank statement, businesses or personal?
Either. We'll allow 100% on bank statements for personal. We actually, on this one, this is a little bit different than our typical program, where we do allow for 50% bank statements. We do a flat 50% expense ratio for business.
Okay, gotcha. We actually have quite a few questions over here. Do you want to answer these now, or did you want to go on with the presentation and answer at the end?
I have a feeling that these guys are more interested about how the product works than how to sell the product. If I'm misreading it, again, please put more questions in the comments. So.
Yeah, no. So all right. So the next one, we got this one from Faye. She says, "Do you require full escrow and title?"
I actually responded to that one on the chat, I think, but up to a $250,000 line amount or loan amount. The assistant owner encumbrance property report is all that's required. If you're going over 250,000, we do require full title report.
Gotcha. How does we got George? He's asking, how does this stack up against credit unions? Can we compete with credit unions on these?
Well, I'm not really ashamed to admit it, but I don't spend a lot of time in the credit union space. Their rates, pound for pound, their margins may be a tad lower than ours, because we, obviously these are loans these are lines that we actually are going to go out and get securitized. However, they're still going to be very, very competitive, and I don't know any credit unions doing bank statement loans. So,
right.
They might. I could be wrong. Advantical, I think, is one that has done some stuff, but I don't know, and they're very, very strict, and they're very difficult to, from what I've heard, get stuff done with. But this is definitely a more of a niche market than a standard, onesie twosie credit type thing.
Right. And then finally, we got another one here. What is the residual income of $3,500? We're getting in the weeds on this one. I don't even know how you would start to answer it. What is the residual income of $3,500 on your guidelines?
What is the residual income? Well, residual income is if you take your whatever you've got left over after you're done paying all your bills, and that needs to be at least $3,500. I'm not sure how to answer that question other than that's what residual income is.
Yeah, if you could, Faye, if you could go ahead and clarify what you're asking there, because that one's kind of a hard one for me as well. Okay, let's back on track this thing. So we've got our first scenario. I love the one. I didn't even really think about that, but what you brought up, it's the fact that you now have something that's dischargeable.
Right.
Okay, do you want me to do scenario 2 or you?
Yeah, go ahead, because I think that we know what this parlays into, but go ahead.
All right, I like these things. These are fun. Okay, consider a borrower who identifies a lucrative investment opportunity in the real estate market. Yes. This borrower has accumulated substantial equity in their home through the years of responsible mortgagee payments. However, they lack the liquid capital, that's everybody, needed to seize this investment opportunity swiftly. Boy, I think we set this one up perfectly. Recognizing the potential of the HELOC to unlock the borrower's home equity and capitalize on the investment opportunity, the loan officer engages in a comprehensive discussion with the borrower. Here's how the loan officer presents the benefits of a HELOC tailored to a borrower's needs. How do we do that, Chris?
Well, first of all, what else do we get when we're helping somebody identify an equity investment in an investment property? We also get a DSCR loan, right? Yep. So you're gonna have both. You're gonna have DSCR loans, and you'll be able to do the line of credit. You're gonna be able to satisfy both of their needs. Right there off the spot, and that they don't have to qualify. They're going to qualify for their income for their home equity line of credit, and even if they're at a little bit of a stressed DTI based on how their underwriting is done, for a fact that they're going to be able to qualify because they can put more money down. So not only are they going to be able to tap their current home's equity and put maybe even a bit more money down than they would ideally for that DSCR loan, because that's going to enable that property to cash flow that much more. So they could maybe be able to put a little bit more money down than they otherwise would by tapping the home equity line of credit, which is going to be great because it's going to give you a much better rate.
Another part of that, what you just said, I was thinking about this. It's like, okay, so we sometimes just get stuck looking at, the carrot that's right in front of our face is motivation to keep going forward. And we got a HELOC. Okay, so the HELOC, what is it going to pay us? Where are we going to make our money? How competitive are we? But what it also does is, like Chris said, it's not the HELOC that you're going to do. It's, hey, would you do a HELOC if you could get a DSCR as a result of it? And the answer is, well, of course I would. I want to do the DSCR on the purchase of a property. Okay, then you're going to have to get paid X in order to get to that. So it sets up your DSCR. But in addition to that, it also sets you up with, referring out to one of your real estate agents, a client who's now looking for a property. From a lender's perspective, if you want to get the attention of any real estate agent in the country right now, go ahead and send them business. This is a way for you to open up opportunities to earn business from real estate agents by creating, potential buyer and client scenarios for them. So it goes just beyond the 2 loans that you're going to be able to do. And
by the way, right? I mean, at some point, listen, we said it for years, right? That it was tongue in cheek. At some point, rates are going to go up, right? And they didn't go up for a long time. And now, rates have gone up. And now we also know what, that at some point rates are going to go down. So yes, the rates are going to go down on their home equity line of credit as well, because prime rate will eventually start getting cut. And your mortgage rates are going to start going down. But at some point, there's going to be a point that their home equity line of credit's at a high enough rate, and their existing first lien is obviously at that low rate, but there's going to be a time where it makes sense to blend that out, and you can give them a better new first, maybe a 5% rate, maybe rates jump down to 5. That's another loan that you can do for that borrower. You can save them money. Maybe they can do cash out again. It keeps you engaged. It keeps you working that pipeline that you have. It keeps you with your borrower engaged on a, maybe not a monthly basis, but at least a quarterly. You can still check in with them. Hey, how's it going? Have you, their birthdays, how's their kids? You work your CRM, work your database, and then continue to talk to them about where their current situation is. Hey, what was your rate again? Okay, I show you here. You had I did a 3.5% rate for you back in 2020. I did that HELOC for you back in 2024. Now it's 2025. Hey, is it time to get that? Rates are now at 5.25. Is it time to refinance both and combine it, do a first and second get that combo down into one loan, give you one low monthly payment, start really paying that debt down. So this is not just a loan for today, but it's a loan for tomorrow.
And it really is a conduit, which opens up opportunities for other loans and other possibilities. And I'll tell you this right now, birds of a feather flock together. If you have, when somebody buys a house, the first thing they do is they tell everybody they're buying a house. That becomes a top of mind conversation. You want to see people get louder when they buy an investment property. That's a chance for a fellow to go out there and peacock even more. And so what happens is going through the process of buying an investment property and post closing on that investment property, your client who gets that DSCR loan becomes your best outside account rep you've ever had in your life. Because when they're sitting around having a beer in the backyard, getting ready to watch the Suns game, they're talking about the investment property they just bought. And of course, their friends, the other dudes sitting around the barbecue, are having the same conversation. Well, you just bought an investment property. I want one too. Guys, you just have to look at the opportunity and the seeds that spread that come from HELOCs.
We have a couple questions here.
Okay, let's go down here. Okay, so Jay says, are you going to be expanding for non-owner loans to Texas?
We're working right now with our capital partner on that. It's interesting. The way that they read Texas law, I don't think they quite understand that there aren't A6 requirements in Texas for investment properties. So right now we don't allow it. We do allow A6 loans in Texas for owner occupied, which is kind of against normal lines of thought. Most people don't do Texas A6 loans. We allow them as long as you understand how they work. You can only have one on a property at a time. So if their existing first mortgage is an A6, we can't do a line of credit. But if their existing mortgage was purchase money or rate and term, we can do a line of credit behind it. You can pay off an existing second mortgage, but you can't have more than one outstanding A6 loan at a time, period. Just can't have it. You could pay off an existing A6 loan with a HELOC. So if you had a $300,000 first mortgage, you could pay it off with a HELOC. You could do that, and then you'd have that variable rate feature. But we do not currently offer this in Texas. We do allow standard fixed rate second mortgages in Texas. I don't know why they have that line of thought, but we'll continue to work with them, and hopefully we'll be able to see that as an improvement in the future.
That's more of a Texas issue than anything else, right? Texas has always had kind of crazy laws about this type of stuff.
Our capital partner is just, I think they read the guideline, or they read the rule that said there are no A6 investment property loans. So they're thinking that maybe that's not allowed, is what I'm guessing, I'm speculating, and they don't allow it for that reason. I don't know why they wouldn't allow it. So we are still working. That was something we found as funny, and we kind of asked them about that, and they said, no, we don't allow that. So we just kind of left it at that, but we just, we're working through it. So, but
I'll tell you what, guys, if you have, it says there's no homestead 50A6 laws for non-Texas non-owner, especially in an entity. So that kind of,
100%, I 100% agree with you. That's why we allow it on seconds, and we actually do Texas cash outs on all of our first liens because we understand the rules. I don't know why this particular, we work with a few different capital partners, but our main one that we work through securitization on this product with, they just have a feeling about that, and haven't gone down on that battle just yet. So, but we will.
Right. So over at Oaktree, tell me about this. So have you seen an increase in HELOCs in terms of a percentage of your production?
It's definitely growing. We've seen it growing quite a bit month over month. This is a newer product for us. We just officially rolled it out last month.
Okay.
So we've seen a number of line of credit applications increase. And we continue, and we think, I mean, obviously, if anybody who is listening to Fed Chair Powell talk today and cringing, higher for longer is there. We definitely see this as a great way for folks to tap their own equity. All the different reasons why we talked about, I know I kind of ran through, we talked about investment property, tuition. We didn't really get to touch on renovation. That's almost an obvious one. But I mean, there's a lot of reasons as to why it's beneficial for someone to do a second lien or a home equity line of credit, because their first lien might just be too low right now. But like we talked about, a loan today creates an opportunity for another loan tomorrow. So,
got it. And by the way, not to gloss over the renovations, but that's a huge component. Again, people who are sitting on their rates right now, they're looking at moving. Well, the alternative to moving, if we're not going to do that, is to go ahead and renovate your property, upgrade it. This is, again, huge opportunities, even for loan officers. For me, you could go out there and if you have a contractor, I would go pair with a contractor and just, start looking at some of this. But let's jam down to scenario number 3.
That was renovation. That was the one.
Okay. Okay.
Kind of went through it a little bit, just trying to be mindful of everyone's time on the call. But yeah, renovation is a huge one. And obviously, some of the other benefits that you guys can always talk to your clients about. Flexible access to funds. We do have a 90-day, just so that everybody aware. One of the reasons that we require that you take out 50% of the line amount at the time of closing is because we have a 90-day blackout period. So everybody knows that things happen for the first 90 days of the loan, servicing, transfers, all that kind of stuff. We want to make sure that your borrower is being serviced correctly, all that kind of stuff. And then once everything's locked in, then they can start drawing down additional funds on their line of credit. We don't want to have happen is we don't have borrowers to, hey, I'm gonna open up my line of credit with 0, and then on 30 days, oh no, I need to take $50,000 out. So it's like we encourage our borrowers to take out as much as they possibly can on the draw period, and then they have the money available to them, and then in 90 days, if they don't need it, they can pay it back or pay it down or whatever the case is. So
that makes sense. After
that 90-day period, they have pretty much unlimited access to their funds. Competitive interest rates, obviously, as we talked about. The rate on the product is good. It's just going to be based on prime, and then whatever the margin is that you work together with your client to build out on. Tax deductible, obviously, you consult a tax advisor. The tax laws can be complicated, especially for higher income borrowers. Underscoring the revolving nature line of credit, the loan officer can illustrate how the home buyer can borrow, repay, and then borrow again throughout the draw period. I have a guy that's a buddy of mine that lives in my neighborhood who's a contractor, and he builds custom homes, and he builds, he does fix and flips. He's very obviously opportunistic, and he's doing a line of credit right now for us for $500,000 because he wants to have money available that he can draw down when he sees an opportunity, do what he needs to do with the money, pay it back, and then have that available to draw back down again. So it's a great resource for self-employed people, speculative investors in the real estate market or other markets. It's a great tool if you know how to use it. It's not for everybody. Listen, it's not for the fixed income 85-year-old person. They need to have a reverse line of credit. They don't need to have one of these. But if it's somebody who's active and they know what they're doing and they know how to use it as a tool to pay down and get debt, or if they need it to consolidate debt and they need to have a lower monthly payment, it's a great tool to use. But it's not for everybody.
But it has enormous utility. Your buddy pulled out $500,000, or he's got a $500,000 line. If he found a great opportunity in a house that he wanted to flip. By the way, did you know that your average fix and flip right now is netting the investor $66,000, and that's down from $72,000. Like if you had that $500,000 line of credit and you weren't even looking for it, but bumped into that opportunity, I mean, you could do it on a moment's notice. If you found that old muscle car that you could fix and flip, or whatever the case is, it just creates enormous opportunity where you just have that sitting there in order to capitalize on situations that may occur. It's a huge advantage if you could do something like this.
I agree. It's a great. I have one. I've got a line of credit.
Okay, so I think question wise, we actually have a few more. Okay, and what we got our conclusion here? Oh, I thought conclusion with the last one. My bad.
No. Client education. Where to find them. And again, we have a lot of there's a couple of different frequently asked questions that we do feel that you should make these available to your borrower. So just in case they have questions about it.
Okay.
Given that it's more complex product, you need to make sure that it's for a little bit, make sure your borrower is educated, because if they don't understand it, they might be pissed at you. Wait a minute, if we're wrong and Fed Chair Powell decides to raise rates in a couple months and the rate goes up, they're going to be like, hey, you thought, understand how it works. If the market gets worse and inflation remains embedded, that's a tool that they can use. And if they raise rates a quarter of a point, your rate could go up a quarter of a point. So it will go up, and that could.
Actually, I got a couple questions right now, and these are great questions here. Is from the 2 to 5 year draw period, are you going to get better terms if you have a 2-year or a 5-year draw period, or does it matter?
It's 3. That's actually a typo. It's 3 years. You're going to get your best terms on 3 years, and a little less favorable terms on 5 years. Not a big. It's a small hit to the margin if you want to do the 5-year draw period.
Okay, and then how often does the payment adjust?
Like monthly.
Okay.
Adjust. At the point in time in which the Fed changes rates up or down, it would go up or down.
Now, so if I'm requesting money, you said you actually get a checkbook. So if I'm requesting money, how long does it take me to actually get that money? So I find a property, is there a 2-day window, 5-day window?
It's usually about, if you're going to call the servicer, it's going to be, they'll have some type of a draw mechanism where you call them and do the request electronically, and it's usually a couple of days. If you use a checkbook, you just put the money right in your account.
Okay. So I think we understand the margin, we understand the index. Yeah, those are the couple that I had.
You want to go through some of the rest of the questions, and we can.
Sure. Let's jump in here. Okay, so we got George. He says, do we have an option for second loan fix? Are we still talking about Texas here? Yes, and I think Chris answered that.
Yeah, Texas, we can do non-owner second lien fixed rate options in Texas.
Okay, so Jay says, well, how long is it until we can start pricing these ourselves versus needing to have our AE price each one out manually?
We are in the process of building out the systems or the product in all of our systems. I don't know. It should be within weeks.
Okay.
And your AE, by the way, has a spreadsheet they can send you, and you can price them.
Okay, so they have a spreadsheet, so they can actually go ahead and get their pricing on a matrix.
Yeah, it's a spreadsheet. It's like a drop down. You just pick all your whatever it is that you want, and it prices that for you. It's pretty slick.
Gotcha.
If your AE doesn't know they can send it out, tell them to come talk to me.
Okay. And then you can green light it. Okay, so George says, to be clear, and again, I think we are clear on this one, you guys offer HELOCs and second loans.
Yes.
Okay. Lena, by the way, appreciate you over here, Lena. So they can't draw for the first 90 days.
Right. They cannot draw additional funds for the first 90 days. So that's why we encourage them to take out, we require them to take out at least half of the line amount, and highly recommend they take out the entire line amount or whatever they might need. And if they have a need for a line of credit, if they have a need for the funds, then they should take it out now. Don't wait.
And then they just turn and dump it back in after 90 days because that loan's going to be sold a couple of times and make the money difficult to get.
Not sold, servicing, transferred, but yes. Yeah.
Okay. And then finally, George says, no California. Do you do these in California?
You said, do you mean in Texas? And he's was answering your question as you were talking, I think. No, California is what he meant.
Oh, okay. Gotcha.
We can do California.
Gotcha. Okay, well that's where we're at with the questions right now. All good questions.
And here's kind of a recap of our matrix. There's a whole pros and cons list. Obviously, you're not going to go over all of this stuff with your borrower. You know what, Brian? I need to add something to this presentation before we make it public for everybody, just because we created it. So we just have to put some legal disclaimers on there. But look, I mean, this is a great product. If you haven't sold one in the past, because they haven't been readily available for brokers to sell, I highly encourage it. I mean, I know Flagstar offers one, but it's like, hey, do a HELOC, get paid $1,000, or do a HELOC, get paid $500. It's like, that's not really what you guys are in the business to do. This is a real loan product that you guys can sell. It's something that you can use to help your borrowers. It's a way that you can help them identify their goals, help them reach their dreams, help them, be a strategic partner for them, help them, buy that investment property, help them plan for college, help them, work with financial planners. I mean, they understand these products and they can help get you in front of borrowers that need them. So this is great opportunity. It's a foot in the door program.
Yeah, and like I said, it leads to just other opportunities. I mean, just it's a stick, stirring the drink type of thing here.
And just and I can't do dual screens because this is in the same presentation, but if you look here, this is the second mortgage credit matrix where we can go to 90 with a 740 credit score, and then it drops off kind of precipitously, right? Once we get down to the 660 range. And investment properties are at 80%, second homes are 80%. This is for a fixed rate second. So there's just a lot more flexibility. For the bank. There's just a lot more flexibility comparatively speaking to the HELOC program. So you can go higher LTVs and those types of things. Some of the lower credit scores are a bit higher on the fixed rate stuff, but again, it's for a more advanced borrower, I think.
Gotcha. And I just want to be clear on this. You don't have to get the appraisal. You're going on an AVM. You could close these things in under a month. What's your average turn time?
Under a month. I mean, you can get these things closed in a week. If you're doing an AVM on it, you can get them closed in a week. It does not take that long. A couple weeks. Yep. We haven't done a ton, so I don't have great data for you. Like, our average turn time on this is whatever, but we can close these things in a couple weeks. They're easy. Get your income approved up front. If you're doing bank statements, we have our bank statement, our income desk tool, or if they're self-employed, full doc, get them approved up front. We can run their income. We'll calculate it for you. We'll give you conditional approval on your income. You'll know what it is. Request the AVM to be done. We do a property inspection, but it's not an invasive one. They just go drive by the property and take a picture of the house, make sure that it's still there, not in pieces. We're not going to go inspect the inside of the property. So there's another thing too. If you're looking at it versus a traditional second lien, and let's say somebody started a renovation project and they kind of ran out of cash that they needed, and they're based, they've got paint everywhere, or they've got, they put a hole in a wall or something that that's not going to, you can't lend on that traditionally. With the HELOC, if you do an AVM product, we're just taking a picture of the outside of the house. They need to get the money that they need to finish the renovation. That's one way of being able to do that.
Gotcha. So, okay, if anybody has any questions, I think we answered all of them today, but I think what Chris is showing here. Contact information is marketing@oaktreefunding.com, and you can see the number 800-968-5773, or you could always go to, it's a great site. It's got a ton of resources on it. Go check out nonqmexpert.com, nonqmexpert.com. Find out more about non-QM loans. Also find out about all the other products that are offered right now by Oaktree. Great lenders, great partners, and listen, huge opportunity with our HELOCs right now. Again, it's one of the biggest, if not the biggest, growing portion of the mortgage market right now. It's opportunity. It's a gateway loan to bigger and better opportunities. It could include your real estate agent partners. It certainly is being that lender for life when it comes to your past client database, because you're giving a lot of folks potentially the opportunity to increase their real estate holdings. And the last time I checked, that ain't bad. Never. So make sure you work with my friends over here at Oaktree.
I did want to say one other thing too. As I was on a forum yesterday, I was reading back and forth. Some folks were talking about HELOCs, and there's a couple of our competitors out there that offer that figure line of credit, where it's like you log in, you run your customer's information, and it spits out a yes or a no, and then it's you go through that process with them. This is not that. This is not a flat fee. This is not a, hey, it's a gimmick to try and get your certain percentage of your business or whatever. This is literally a loan that you can use to make yourself money for your business, that you can use to be able to get your client what they need, exactly what they need, and it's a manually underwritten loan. So this is not a computer that goes in and says, boop, 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 it's some black box that determines whether or not you can get this loan for your customer or not. This is actually, we have guidelines, we have a matrix, we can make exceptions, which we do all the time. So this is a real underwritten loan that you guys can do, that you guys can participate in, that you can make real money on. It's not a, it's a traditional, black box type of credit, or I'm sorry, computer automated whatever decision that it is what it is, and that's it. That's the end of it. So this is a great product. I think that if you guys give it a shot, you're going to like it. You like dealing with our team. If you have an AE, if you don't have an AE yet, call the number that's on the screen. We'll get you set up with someone great, and we're excited to help you close more loans.
Awesome. Well, Chris, thanks for your time today. I appreciate it. Appreciate everybody being on board today. See this is an opportunity and take action. I just think that's where it is. Take action.
That's right.
All right. Well, Chris, thanks so much. And everybody, you have a great day.
All right. Thanks, buddy. We'll see you. Bye.
Bye.